Hi everyone, I'm Prof. O. In this video, I'm going to show you what a gross profit and gross profit margin are and how to calculate them. First, quite simply, our gross profit is what we get when we subtract the cost of goods sold from our revenue or sales. Note that our cost of goods sold includes the direct costs associated with producing a product or service. This includes things like labor and our cost of materials. Gross profit is sometimes referred to as sales profit or gross income. Gross profit is also found on a company's income statement. Gross profit is a very important measure to help us understand the performance of a company, including its profitability and financial performance. Specifically, it is helpful in determining how efficiently a company uses its labor and its supplies in its production of goods and services. Let's take a look at an example. Here we have a very modified income statement. In this example, we are only concerned with the first three lines: revenue, cost of goods sold, and gross profit. The brackets indicate subtraction. So here we are subtracting 500,000, which is our cost of goods sold, from 885,000, which is our revenue. When we subtract 500,000 from 885,000, we are left with 385,000. That is our gross profit. As you can see here, it is the same formula that we looked at earlier. Our revenue minus our cost of goods sold gives us our gross profit. Now, what about gross profit margin? Gross profit margin is one of the most commonly used profitability ratios. It shows how much a company makes after paying off its cost of goods sold. One way to think about it is that the ratio indicates the percentage of each dollar of revenue that a company keeps as gross profit. All right, so let's take a look at the formula. It is our revenue minus our cost of goods sold divided by our revenue. Remember that the gross profit margin is typically shown as a percent, so therefore you will want to multiply whatever you get from this formula by 100. Another way to think of that formula is that it's our gross profit in the numerator, which is just our revenue minus cost of goods sold. Again, we're just trying to understand which proportion of our total revenue is gross profit. Let's go back to our example and calculate the gross profit margin. Remember, in our example, our revenue is 885,000 and our cost of goods sold is 500,000. All right, so if we plug in our revenue and cost of goods sold into the formula, we would say 885,000 minus 500,000, which is 385,000. We would then take that and divide it by 885,000, which would give us 0.77. We take that 0.77 and multiply it by 100 to show it as a percent. That 77% is our gross profit margin. This means that 77 cents out of every dollar of revenue is retained as gross profit. Gross profit and the gross profit margin are both good indicators of a company's profitability, but they are insufficient on their own. They are best used alongside other financial metrics to help us get a good understanding of the big picture of a company's financial performance. Gross profit margins are best compared within industries because they vary across industries, but in general, the higher the better. So, if we want to increase our gross profit and as such also increase our gross profit margin, we typically have two key ways to do this. Either we increase the price of our goods with the hopes that our higher selling price doesn't deter our customers, or we reduce our cost of goods sold, which may mean we acquire materials from another supplier. That was an introduction to gross profit and the gross profit margin, two very important concepts in business. Thanks for watching.